So everybody who's in the meeting, you can see here that we've got this in the financial year pack which you can download. Feel free to scan that QR code. All the things that we promised you and more are in there. So just grab them when you get the chance. You might kick it off. Okay. Good afternoon, everybody. Excuse how I'm looking and stuff today. I'm still on paternity leave. My wife's in the other room with my toddler, and I've got a newborn who's 2 weeks old just over there. So you might hear some background noise, but I'll try my best to mitigate the noise and stuff. But I appreciate your patience through this. Today, we're very lucky. We've got Carla Neshi, our head of finance, my business partner, the head of mortgage broking, with us today. And we've also got David Guerrero, who is our accountant. He's the man that we send all of our clients to talk about their taxes, setting up their businesses, trusts, any complex company structure, or just learning how you can get more money on your tax. Unfortunately, Matt couldn't make it today. He is very, very sick. He's been sending me photos of his temperature. So I've sent him my mum's secret recipe for chicken soup, and hopefully he gets better soon. I'll glaze over his slides today so we can have those conversations. What we will do, if you do have questions about superannuation, we will note them all down, and then I'll get him to jump online, answer all your questions for you, maybe send a separate video. We will attend to his questions. You want to make sure you get the most value that you can today. Okay, here we are, financial triage. What every healthcare professional needs to get right before the 30th of June. And, truth be told, you don't, David, you can weigh in here. You don't have to do all your tax stuff by 30 June. You do have a bit of time. What's the time limit, David, that we've got to get all our tax stuff done for this financial year?
Well, you actually don't need to lodge your tax return until the 31st of October. So yeah, you can be a little bit late and you have a bit of that grace period. And actually, if you actually lodge with a registered tax agent, the deadline is actually 15 May of the following year. So that gives you plenty of time to get your stuff in order. But please don't leave it to the last minute.
Yeah, don't leave it to the last minute. Just because we said we can take your time doesn't mean you should. So we'll get straight into it. Okay, end of financial year. I don't know about all of you. This, for me, it really is a great opportunity for you to pause, reflect, reset, to take a minute, to take some space away from your daily life. You're all out there saving lives, running the hospital, improving healthcare. And it can be very difficult, raising a young family, running your businesses and everything else. But it is so, so, so important for you to create some space. Even if it is a couple of hours where you can sit with a professional, with an accountant, with a financial planner, mortgage broker, and most importantly, sit down with yourself or your loved ones, your partner, where you can think about your personal finances. What have you done this last financial year? Did you achieve your financial goals? Do you feel stressed or anxious about what you have or haven't done? And then set some goals. What do you want to be doing over the next 12 months? And what things should you be changing? The interesting thing about what we do in finance, it's all very scary when you don't work in it. But once you kind of dedicate the time and sit and get into it, it's not as scary as you think. There are a number of little small tweaks that you can make along the way that can have major, major benefits over the course of the year. We'll talk about some of those specifically when it comes to taxes. And we'll also talk about them relating to your mortgages and your finance. But the big thing is, and what we want you to take away from today is we want healthcare workers to be more proactive and not reactive. You are all naturally so helpful. You give so much of yourself to everybody around you. And we want to create that safe space for you to start thinking about you, putting yourself forward, and you need to take care of your finances. Because if you're not on top of your money at home, it really is hard for you to think and do everything outside of your household. Okay, so this one here this is a really simple thing that the team and I like to do. I use this calculator in my household. I like to get a sense of our net worth. we like to use, I've created a very simple calculator that when you download the pack, you'll get a copy of it. And I'm going to show you that calculator right now. It's called the Healthcare Wealth Check. Super ugly. I know Carla is probably cringing right now, but I find that the simplest things are often the easiest. We want to be easy, simple. You can do this on an Excel spreadsheet. You can do it just in a old paper and pen, but it's good to get a sense of where you are. And it all really starts with your budget. It's good to understand what your income is, how much money you get paid. So what's your income? How much goes towards tax? How much goes towards super? And then what's your net figure? So how much do you actually end up taking home? So it's good to have that there. Then we want you to map out how much are you spending? What are all your individual expenses? I know it can be scary, but here's my hot tip. If you've got a pen and paper, write this down. You can actually take your financial statements, your documents, you can download them from your internet banking. And if you want, some of you may or may not feel comfortable doing this, you can put it into one of those AI search engines. You can put it into ChatGPT and say, hey, break down all my costs and tell me what my expenses are. If you don't feel comfortable doing that, there's lots and lots of software available to help you categorize your payments to understand how much money you're actually spending and to find out what your monthly surplus is. From there, you can work backwards to set yourself up some different goals, whether it's buying your own home, buying an investment property, buying shares, all that type of stuff. Then we want you to work backwards, figure out what your liabilities are. So what's all of your debt, all your buy now, pay later accounts, your HEX debt, your credit cards, all your liabilities, and then put in all your assets. How much cash have you got? Superannuation investments, property, vehicle, all your other assets, the gold that you've hidden away in your backyard. And what that does is it comes into this neat little dashboard where you have clarity. You know that the financial year 2024-25, this is what my asset position was. This is how much we're saving. And it gives you a sense of where you are, and you can start tracking where you want to go. Carla, David, is there anything you want to add to my very ugly, simplistic budgeting cash flow calculator?
No, I think it's great. I mean, like you said, you want to keep it simple. I personally track my P&L, cash flow, and net worth on accounting software. I know that's very nerdy, but I think it's really important to track because what gets measured gets managed and what you focus on grows. So I actually really like seeing the trends month on month. How is my cash position moving and what is my net worth doing? So again, I think keep it simple, but again, you want to take the time this end of financial year to actually see where your position is at.
It's scary. And one of the things that can happen when you actually have a look at what you're spending, you'll notice you'll have all of these ugly little subscriptions that you may not be using. Some people I've spoken to have got 2 or 3 gym memberships. They've got, Spotify accounts, all of these different subscriptions that they don't need. And I run this audit every year inside my businesses, myself personally. I know Carla's probably got 12 different streaming services. And it's important to keep a monitor of all these little drains because you'll be surprised at what you can save when you start to shine a light on your budget.
And you should really treat yourself like a business. There's a reason why business owners will look at their financials every month, and that's to monitor the health of the business. How do we grow this? Are there any anticipated liabilities or big expenses that we need to forecast for and therefore create a buffer? So it's all really about, that sense check and being sensible with how you spend your money.
Perfect. And by the way, everybody, if you have questions, leave them in the comments. Holly, Carla, we're all moderating. We'll answer them if it's relevant for now, or we can save them to the end. Okay, my presentation mode isn't working so well. Here we go. So this is where Carla can step in. I will touch on this slide very, very quickly. People like to talk about good and bad debt. We created this little matrix, and it's a way for you to think about how you can treat your debt, how there's good and bad ways to use your debt. There are good and bad ways to use your home loan. There's good and bad ways to use your investment loans. So there are certainly some types of debt are better. Good debt, generally speaking, is when you're buying assets. Bad debt is when you're buying depreciable items, cars, and things like that. But we're pragmatic. You got to live your life. You've got to get debt to do different things at different stages. For everyone to just say credit cards are bad debt, it's just a bit. It feels a bit callous and not realistic. I have a credit card. Everybody's got credit. Many people have credit cards. There are good and bad ways to use that debt. So, Carla, did you want to weigh in here?
You've summed it up nicely, Dom. I think that when you think about your debt, people get really concerned about how it's going to impact their credit score. Is it going to build their credit score? Is it going to decrease their credit score? How is it actually impacting me? And Dom is right. There are some debts that, are more effective than others. Some debt is considered as good debt because it does build your credit score. For example, having a credit card shows to the bank that you can make repayments on time, that you have a good credit history and credit worthy, right? But then when it actually comes to getting your home loan, it can be considered as bad debt because they don't want to have that additional lump sum of cash sitting there or that credit limit sitting there. So it just depends on the lens that you're looking at this debt and how it actually impacts your overall financial positioning. Some specific debt that we like to look at as good debt is your property debt. When you have home loans or investment loans, these loans are considered good debt for you because that's helping you build your net worth over a longer span of time. Whereas you might look at some debt like car loans or personal loans where they have high interest rates or they have, cars don't really appreciate in value, or not many do. So that could be considered as a negative debt, but it just depends at the lens that you're looking at it for and what the use is actually for. For example, in this column here, we're talking about car loans. If it's for business debt, it's good. It's a business use. If you're looking at personal loans and you're thinking about starting up a practice and you need to invest in equipment or things like that, that's purposeful debt, so it's good debt. But if you're using it for things like going on holidays or buying a dog or things like that, it can be considered as bad debt because it's not making you any money and it's considered as a liability that's not giving you much. So except for love. But when we look at these things, that's the type of lens that we like to consider your debt from. Look at it from what it's going to do, what's the purpose of it, and how's it actually going to impact my long-term finances. And that's the way we consider your debt.
So there's a few things to consider. Obviously here, you don't want to over leverage. When you are going to get a home loan, when you're going to get an investment loan, it's critically important to understand what your payments are going to be today, what they could change or what they could turn into tomorrow. But lots of people 2-3 years ago got debt at 1% and 2%, and now it's 6.5%, and they've got in mortgage prison or in a lot of fear and anxiety in their households. There are different times when, for instance, getting a car loan may actually make sense because you need to have a car and you don't want to go and put $50,000 into a car. Maybe you want to use a small deposit towards a car and use the remainder of your cash to invest in property. So it does make sense at different junctions to use these different types of debt for the purposes that you need it. Okay. So, by the way, David, did you have something you wanted to add here?
No, I think that there's another point about just being able to considering consolidating some of your debt. So you might have these really high interest credit card loans and personal loans and things like that. There's an opportunity to actually consolidate some of that debt under your home loan, which is generally under a lower interest rate. So that could make a significant impact on your cash flow and then hence your borrowing capacity and things like that. So again, I think looking at you doing that little exercise that Dom showed before about looking at all your debts, there's an opportunity to actually kind of manage the payments and consolidate some of that.
Absolutely. That's a really, really good point. Thanks for that segue. Okay, so this is where Matt's ball should be here. He's not. I'm not a financial planner. I used to be. I can't really talk about superannuation. David, I don't know if you can weigh in on some points, but there are different types of contributions that you can make when you are when you're talking about superannuation. There are concessional contributions and then there are non-concessional contributions. Basically, that's when you're deducted from your gross income. So that's before you pay tax. And then there's non-concessional contributions where they're deducted from your after-tax pay. That's when you're making additional repayments. Now, superannuation is something that people don't like to think about, talk about, because it's like make-believe money. But it's real. It's your money. It's your cash. And if there's one thing that you're going to take away out of today, it is log in to your superannuation account. Go and find your passwords, forget your password, whatever you need to do, call them up, log in and have a look at where your money is being invested. Have a look at how your superannuation is performed. Some of you have probably got, 2, 3, 4, 5 superannuation. So, our recommendation, this isn't financial planning advice, but it is to go out and consolidate your superannuation. Try and have just the one, so you're not paying unnecessary fees. Many superannuation accounts have insurances attached to it. So you may have a whole bunch of different superannuation accounts with lots of different, you might be overinsured, so paying fees unnecessarily. And all these fees that you're paying in superannuation whittle down your retirement fund. Dave, is there anything you want to contribute here to the types of contributions or chat about superannuation?
Yeah, definitely. Well, when you mentioned that monitoring your superannuation, you're reminding me of this negative story that I had. Early in my career, when I first started working, I was obviously working and had got superannuation within this company. And then when I left that company, because I wasn't aware of it or didn't monitor my superannuation, because I left the company, I was actually slugged with all these additional fees for being like a non-employee. So when I eventually looked at my balance a few years later, my balance was effectively wiped out. So that was pretty devastating. So yeah, I think it's very important to monitor your superannuation balances and actually, look at the fees and stuff like that, because they'll make a considerable difference to your retirement savings.
100%. My father had a similar situation where he had multiple superannuation accounts. He didn't realize one of the super funds actually went bankrupt and he lost $150,000. He's now 62 and he's, can transition to retirement and, he would have liked to have the additional $150,000. So get on there, log into your superannuation, have a look at what you've got, consider consolidation. There are lots of different government websites and platforms that can help you out.
Also,
Yep.
just to add to this before we move on, banks will ask to see your superannuation, especially as you get older. So as you are approaching your basically your 40s, the banks start looking and go, well, a loan time is about 30 years and you should be retiring around 65 to 70 years old. So they want to see, should be. They will look at that and they want to see what your super contributions look like. So that way you do have an exit strategy long term where you have some money that's going to protect you when you're not working. So getting a better understanding of your superannuation now does help a long way with your mortgage, because the bank does look at it and they do want to know what's happening to make sure that you have a financially stable future. Just another thought to add.
Perfect. Thank you.
Yeah. And sorry, could I speak to one of the tables above? I'll just quickly touch on it.
This one here?
This one over here, because I think this was a really good example in showing the impact of salary sacrifice and making additional concessional contributions into your super. And what this table effectively demonstrates is that with your gross income, you're effectively shifting or reducing some of your personal income, and you're shifting that into superannuation, which is a lower taxing environment. And in this scenario, we can see that the total tax payable is lower overall, which will increase your net income overall as well. So it's just important to understand that you have different levers, you have different entities at your disposal when it comes to investing, where it comes to actually earning and deriving income. And all those different entities have different tax rates. And hence, by leveraging and understanding those different entities, you're able to manage your tax liabilities. Yeah.
Thanks, David. That's a really good point. Taxable income for most people is 32%. Going into super, what is it, David? If it's concessional, it's 0. And if it's non-concessional, like 15% or something?
Concessional, yes, 15%. And
Yeah,
0
there you are.
are non-concessional.
Here he is, tax and accounting specialist, David Guerrero.
Yay.
Okay, common tax deductions. Let's go.
Yeah, so happy end of financial year, everybody. Can't believe another year done and dusted, but it means we can work on our taxes. So a very exciting time. And to help make most of this tax season, I'll be sharing a list of common tax deductions for healthcare professionals, as well as some common non-deductions, mistakes that people tend to make, and some other tax strategies to consider. So the first one is professional memberships. So perhaps you're part of the Australian Health or the Australian Medical Association. The annual cost of these memberships are tax deductible. Education, so if it involves you increasing or maintaining your skills and knowledge in your current profession or will lead to increases in your income in your current profession, then those costs are tax deductible. Occupation-specific clothing, perhaps you wear scrubs or you have branded uniforms with a logo on it. The cost of these pieces of clothing are tax deductible. And even if you don't actually have to pay for them, they're provided by your employer. The laundry of this uniform is also tax deductible, and you're able to claim an allowance of about $150 a year. The work use of your phone and internet, even if it's a case of you just liaising with your manager and organizing your shifts, you can claim a portion of your phone bill as a deduction. Working from home isn't too common for healthcare professionals, but definitely there's a rise of like teleconsultations and things like that as well. So if it is applicable to you, you can claim some working from home deductions. And with this, you have two options. So you can go through the allowance method, which involves you estimating how many hours you work during the year and then timesing that by the rate, which is currently 70 cents per hour. Or you can go through the actual cost method. So detailing all your overhead running expenses, utilities, internet, things like that, and apportioning it for work use. The next one is a travel between job sites. So perhaps you do client consultations in one site in the morning, and then in the afternoon, you do client procedures, medical treatments somewhere else. The travel to and from those different work sites with the same employer is tax deductible, so you want to include that. Insurances, which includes professional indemnity insurance and income protection insurance. Donations, which includes workplace giving and tax preparation and advisories. If you decide to use a tax agent to lodge a tax return, of course, that's tax deductible, but you can also do that on your own via MyTax via the ATO portal.
How much does it cost to get a tax return done? Just a simple PAYG, David?
With us, it's $300.
Okay, so it's nothing, and it's very little, and it's you can claim it back on tax.
Yeah, exactly.
Wonderful.
So I think that's something people never really consider, that you're actually going to get some of it back. So usually it's worthwhile. It's a worthwhile investment, particularly if it allows you to ensure that you actually are able to claim all your deductions. Awesome. So moving on to common non-deductions. So home to work travel. So an area where I've seen confusion with this is with people working at different locations. So for example, from Monday to Wednesday, you work at Royal North Shore Hospital, and then from Thursday to Friday, you work at Westmead Hospital. It looks like you need to work at different sites to perform a role, but because you're actually dedicated on those sites on specific days, that commute to that place of work isn't tax deductible. Different story if it's in between those sites and for the same employer, but the initial commute to that place of work is not tax deductible. Education for a new job. So an area where I've seen also a bit of confusion with this is, nurses getting into cosmetic injectables. And when it comes to education or any expense, really, it has to relate to the income that you're actually paying tax on, that you're putting in your tax return. So, for example, if you're working as an ICU nurse and you want to get into cosmetic injectables and you take on a course, at that point in time, you actually can't claim it as a deduction. I know it's in the realm of the medical sphere and stuff like that, but does it relate to you maintaining your knowledge as an ICU nurse? No. Does it help you earn more income as an ICU nurse? No. So hence you can't claim it as a deduction. So the tip here is to actually get a part-time job and a casual job, get some form of income on your tax return in this field, and therefore you can actually claim the education related to that income. Clothing you can use outside of work. Again, another area where I've seen a bit of confusion with this is, say, with nurses who have the protective footwear. So if there's leather soled, non-slip footwear that you wouldn't really wear anywhere else, yes, that's tax deductible, but sometimes people just wear sneakers because that's their preference. And because you can wear that outside of the workplace, you can't really justify claiming that as a tax deduction, even though you use it exclusively for work. The next is not apportioning for work use. So sometimes people might just go and try and claim their phone 100%. But you have to also look at it from the lens of the ATO. They're going to look at that and determine, like, if you need to use your phone 100% for work or primarily for work, your employer should really be giving you a phone or providing you an allowance. So it doesn't make sense for you to be claiming all these big deductions 100%. And unsubstantiated claims. So if you don't have any receipts or permit documentation, knowing that you have to maintain it for at least 5 years as well, obviously you can't make up any deductions and claim that. And lastly, it just really has to make sense for your occupation. The ATO has ways of looking at your occupation and kind of running analytics as to what deductions are reasonable for the occupation. And if it looks weird, it might get flagged and you might get audited. So if you're a medical assistant, it doesn't really make sense for you to be claiming travel deductions, and hence that might be flagged. And we can actually see that on your ATO report. And hence you're more likely to be targeted for an audit. Awesome. And then strategies, some other things to consider. So prepaid deductions. So how tax works is that you can actually claim deductions when you actually pay for them. So for example, if you have a membership relating to FY26, if you pay for it now, you can actually claim it in this financial year. So it might not make a big difference year in year, but a scenario in which people might really take advantage of this strategy is, say they are anticipating that they're going to have a lower income next financial year, perhaps you're on maternity leave, you're going to be in a lower tax bracket, and hence you may want to bring forward some of those deductions in this current year where you have a higher tax rate and really make use of those deductions. The next one is superannuation contributions, and that was kind of illustrated in Matt's table just above. And the biggest benefit, again, of this is reducing your personal taxes and moving it into a lower taxing environment like superannuation. The only thing I'll say with this is to consider is that, of course, if you're moving money into superannuation, you're not really going to see this money until you retire. So it really depends on your goals and your strategies. So some instances where I'll really see people utilize making additional superannuation contributions is if they're approaching retirement, so of course they're going to see that money soon. If they have a too much money problem, which is a problem to have, and are okay with putting that money in superannuation and growing their wealth in the background there, or if they're about to encounter like a big capital gains event, you're about to sell an investment property, you're about to make $1 million, and then hence actually trying to, like, the net impact of you reducing your tax bill can make a significant difference on how much tax you pay and your overall net income. So there are some scenarios if you're ever anticipating that, it's well worth really planning well ahead of time, because it can make a significant impact on your overall tax liability. The next one is property investing. So property investors have several tax concessions that are available to them. So there's negative gearing and depreciation deductions. I won't delve into this too much because Healthcare Home Loans has many presentations, very many resources on that. So I'm sure if you keep following them, you could be informed of the next one. And then lastly, SMSF, which is a combination of utilizing your superannuation contributions and investing in other assets like property, which have several tax concessions.
And David, for SMSFs, some people in this webinar probably got, a good amount of money. How much money do you think you need to set up an SMSF? Like how much do you need to consider setting up an SMSF?
Yeah, so it really depends. There's actually no limit, like no minimum amount. So theoretically, if you had $100 in superannuation, you could set up an SMSF. APRA came up with a suggestion that balances over 200K start becoming, I guess, that break-even point, because you need to consider that with many
Fees.
with fees, yes. So how traditional funds get their fees, how they get charged is generally on your balances. And so as your balance really grows, your costs will actually grow in line with that. Whilst with the SMSF, the cost of servicing it is generally fixed, and hence the cost compared to the value of superannuation will decrease over time as your balance increases. But again, I think even when you're approaching 150K to 200K, that's when you would want to start considering establishing an SMSF. And then definitely above 200K, from a purely cost perspective, it's worthwhile looking into it because you're basically being charged on the balance of your superannuation.
Cool, thank you. Okay, here we go. Plan like a pro. What's your number one priority? So this is really about getting a sense of what to do. How do you build your portfolio? How do you get set up? What's your next steps? Now, this slide, if you're interested, we created wealth blueprints. So if you scan that QR code earlier, you should be taken to a wealth blueprint that's appropriate for you. Now, depending on what profession you're in, nursing, you're a doctor, different types of specialists, allied health, you're in administration, there are different ways to approach your career path, but then your investment path. Doctors, specialists, allied health professionals typically like to go and set up their own private practices, buy buildings, buy machinery. People that are, your nurses, your midwives, administrators of the hospital, maybe they don't want to set up their own practice. They might set up their own business, but they're looking at building up property portfolio, buying their own home, paying off their own home. So we encourage you all to download this wealth blueprint, have a read, see what you can do, and let it inspire you for ways to think about building wealth over the long term. Carla, do you want to talk about this slide, from chaos to clarity?
Yeah, so this was a great opportunity, to be honest, and it was really, really great working with Shani. She was really nervous as a first-time buyer because she had a couple of different opportunities available to her. She'd spoken to a bunch of different banks, and she was a little bit confused, to be honest, because she had spoken to her original bank that she's been with since she was 4 years old. She was a Dolomite girl, and was told she could do it one way. She spoke to another bank because she was told by her friend that she should speak to them and see what they're going to offer her. And she was a little bit confused because everyone was providing her with different borrowing capacities, different deposit requirements, and telling her she needed to pay lender's mortgage insurance and everything else. So that basically scared her, and she wasn't ready to approach buying her first property until she had spoken to us. She had seen us at one of the days, came over to us and booked a meeting, and as we were discussing, we were able to save her a fair bit of cash. So where she was originally told that yes, she could put in a 5% deposit, she was going to get hit with a 7% interest rate. Or the other bank who said, oh, yes, you can put in a 5% deposit, but you have to pay lender's mortgage insurance because you own way too much money and can't go under the first home buyer scheme. Both banks didn't realize that she was a nurse and she had the ability to purchase with a 10% deposit. she could save up to $16,000 in her lender's mortgage insurance, which allowed her to pay no lender's mortgage insurance. She also then saved on her stamp duty, $28,000 being a first home buyer. And other little things. Because Shani was an Aboriginal first home buyer, she was able to then unlock another $10,000 in matched deposit. So her $10,000 was then matched with a further $10,000. And another little sneaky thing that everyone always forgets is you do have other fees outside of your mortgage, like paying for your solicitor or conveyancer who reviews your contracts. So she was able to access another $2,500 in legal and admin fees. So in all of that, her upfront cost only ended up being $65,000, and she saved, and her fees were only $343 in government fees. So through all of that, where she was originally told she would have had to pay $16,000 in lender's mortgage insurance, and she would have had to put way more cash in and way more money towards her down payments and repayments, she unlocked a rate of 5.72. She ended up buying a home at $750,000, and she saved about $117,000 in upfront costs. So these are just some of the benefits that she was able to unlock with us, and you'd be surprised what is actually available to you. A simple conversation can really change your financial position and can save you thousands of dollars in the long run.
Absolutely. And get you started much, much quicker, which is super important. Okay, here we are. Take action today. So I'm hoping that you all got to have a look and you've got your packs by now. If you don't, let us know. Holly will help you. But you should have your net worth tracker. We want you to go away and check, or go use your net worth tracker. We want you to check your superannuation. We want you to download your deduction cheat sheet. That's a lot of the stuff that David was discussing. And if it is appropriate for you, we'd love for you to book a financial health check. They're 10 to 15-minute phone calls with our team. We do talk specifically about your mortgages, your interest rate. We like to tell you what your borrowing capacity is. It is solely about lending and borrowing. But for all your other services, we encourage you to take all these actions.
And also, just to add to that, generally when you speak to our team and if we identify anything that needs actioning, like your superannuation, or we see that your accounts could be better managed, we will automatically refer you through and say, hi, like we'll obviously ask for your, if you're happy for us too, but we would like to refer you to the relevant people so you're not left in the lurch wondering what you need to do about your super or your taxes or whatnot.
Exactly. Questions?
There are some questions.
Let's go.
So there's a question here that said, it was just more about property, Don. It was, what is the average growth rate of property if shares is 7.5 per annum roughly?
The average growth rate changes. Generally speaking, it's about 7-ish% across the nation. The average growth rate changes drastically whether you're looking at capital cities, regional markets. If you're looking at New South Wales, Victoria, it changes state to state and is heavily impacted where you are in the economic cycle. You know, Brisbane, Perth, they just grew like 50, 60% over the past 36 months. Melbourne has done nothing. It's gone a little bit backwards. Canberra has suffered recently. So depending on where you're looking and what type of property you want to buy, houses typically grow faster than apartments, but apartments typically give you more cash flow. So yeah, the average growth rate is generally about 7%. The power that comes from property is a couple of things. One, you get growth. So the 7% is growth on the asset. Two, you've got leverage, which is what we're talking about today. If you've got the ability to go buy say $1 million property, you put in $100,000 and it grows by 7%, you've made 7% on $1 million, which is 70K. Whereas more often than not, you can do margin lending, but if you buy shares, if you put up say $100,000 in, that grows by 7%, you make $7,000. Property also has benefits, which shares do too, of providing an income. You can get dividends from shares, but property has rental income. And then you get all the tax benefits that David was talking about. So your depreciation, all the expenses related to running that property, and you can use that to lower your marginal tax rate.
Beautiful. Next question is, what is the minimum deposit for an SMSF home? David, you can weigh in here, but some banks will require a 30% deposit.
And you can't buy your home.
You can't buy your own home, but the minimum deposit I've seen 10% actually. But I think it's always going to be specific to the lender. And certain lenders have different requirements, like a post liquidity requirement and stuff like that.
And the property.
And a property.
What property you're buying? If it's a house, an apartment, a shed, if it's a vacant block of land, if it's a farm, the property you buy then determines. It's very, very hard to do SMSF lending. We do it, but it isn't the same as borrowing money outside of superannuation. And there's a lot of rules, as David's talking about. Sorry, David.
Yeah, but it is a good way to, like, expand your property portfolio. And I think one of the best benefits, here is that if you invest in your superannuation, it doesn't necessarily impact your borrowing capacity in your personal name and vice versa. And so again, like utilizing these different structures allows you to build your net worth overall and hopefully creating a lot more lines in Dom's spreadsheet.
Correct. What other questions?
No other questions for now.
Yeah.
No?
There was a question about parking fees for if they're tax deductible. If it's to your principal place of work, then no, it's not tax deductible. But if you need to go to different sites within the same day for the same employer, then yes, those parking fees are tax deductible.
Not parking fines.
No parking fines, no.
If any more questions? No. Here's another chance, team. Get your phones out. Download your blueprint. Download the packs. Get all the value you can from today. Scan that QR code. Put your details in, and get all the value you can from today. If you feel like, yep.
One last question. Why is July the best time for lending?
July isn't the best time for lending. Any time of the year is the best time for lending. It's whenever you can do it. In fact, December's a bad time to go and do your lending because everyone goes to sleep, and January, there's not a lot of people coming back from holidays. But February to November, that's a great time to be doing lending. July, it's a psychological thing. It's you're doing your taxes, you're preparing for the next financial year. It's good to just put a line in the sand and say, from this date, I'm going to review my finances and log into my superannuation. I'm going to do my budget. I'm going to get a sense of what's going on. And but aside from January, December being bad times, every other time is a good time for lending.
I think it's always a good time to really always understand what your borrowing capacity is, what your financials are, because that allows you to kind of plan for the future. If you know that you're currently just under your borrowing capacity for that investment property, then you might need to work on increasing your income in this financial year, or decreasing some of your expenses and shuffling things around. It's just a case of more financial information you have available. It allows you to make better decisions around your finances.
Agreed.
We've got two
everybody. Yes.
Last questions are, I logged in late. Was this recorded? Yes, this is recorded, and we're going to share this live. You will have some videos that you can watch on YouTube or Instagram, wherever you like to find us, whatever your preferred platform is. And the other question is, can you please send a link to download? We can. What I'll do is, Habitat, if you can pop your email, you know what? I'm going to message you directly, and we're going to sort that out together. Is there anything else, guys?
We have another session tonight at 7 o'clock. Is that right, Carla? 7, 6, 7?
Yep.
Yep. So if you miss this one, you want to watch the next one, you're more than welcome to. Otherwise, have a lovely day. It's sunny here in Sydney, and happy tax time.
Woohoo.
Happy tax time.
Bye, everyone.
Bye, everyone.